Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. And my company, Taylor Hard Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying, What is Chen Selling? And Chen will be with me a little later in today's show, so you'll want to hear what he has to say. With regard to his newsletter, you do need to put your name on a waiting list. Chen accepts new subscribers up to a set number only during the first 10 business days of each new quarter. So starting April, Chen will be accepting new subscribers. To sign up for his letter, put your name on the waiting list, and to sign up for my letter, go to miningstocks.com, or you can call our office here in Queens, New York at 718-457-1426. I want to thank each of you for listening to this show, making it one of the more popular shows in the Voice America Business Channel, and would also like to encourage you to continue sending along your questions, comments, praises, criticisms, whatever you have to say, whatever's on your mind about the controversial content of this show. Many times anyway, at least it's quite controversial as far as the mainstream is concerned. So if you've got a gripe or if you've got a praise or whatever, send your thoughts along to questions4taylor@gmail.com. Questions, the number 4taylor@gmail.com. Also, you can follow me on Twitter at jtaylormedia. Want to thank our sponsors for making this show economically viable. Our sponsors for today's show are Novo Resources, Dynacor Gold Mines, and Copperbank Resources Corp. Michael Oliver, Chen Lin, and Jeff Deist are my guests today, and they are scheduled to be with me in that order. Few, if any, investment pros other than Austrian economists forecast the market collapse in the housing market bubble. But Austrians, even some Austrians, had sort of those that were whose paychecks were perhaps too closely attached to the mainstream, didn't see it coming. But the Austrian economists were among the few who actually were calling for a collapse of the housing market. So with clarity, Austrians that weren't too attached to Wall Street knew that the Keynesian monetarist and economic policies implemented during the Greenspan years would certainly sooner or later fail. So don't let anybody tell you that no one saw it coming. Certainly that's what we heard from the mainstream. And you can imagine that you're going to hear it again in the future when the next bubble comes. But the important thing to keep in mind, though, is that the same failed policies of the past are continuing to be applied, even though it is clear to anyone with eyes to see that the policies are not only failing to generate a vibrant economy, but also they are setting us up, creating more bubbles for the next major economic and market catastrophe. What about a half past the hour today, I will be talking to Jeff Deist. He's the president of the Mises Institute. I want to ask him to share some of the insights of the Austrian economist at the Mises Institute, and see what they have to say with regard to the U.S. economy and where it is headed at this point in time. After our first commercial break in just a few minutes, my partner Chen Lin will be joining me to talk about sectors in the equity market that look most promising to him now. And the one that he is most excited about at present is the biotechnology sector. In fact, Chen thinks that through the use of genetics, the biotech industry is on its way to eradicating cancer, and he thinks within the next decade. Could that be possible? Well, I want to ask Chen how he can make such a bold statement and also get his views on oil and gas markets, and maybe he'll have some things to say about the gold markets too. But getting back to the Austrian School of Economics, one of the problems that the Austrian thinkers have, in my view, and I include myself among them, is one of timing. You can be right about the future event, but if you're way too early, years ahead of time sometimes, the time value of money can really wreck your portfolio, big time. I know because I speak from experience on that as well. That is why I'm really pleased to have with me Michael Oliver. Michael is indeed a free market Austrian economic thinker, but he avoids the problem of being way too early by applying his economic theory. In fact, he lets the markets do the talking. He applies his own proprietary technology tools, technical tools, analytical tools that he uses for a better sense of where the markets are heading and for a sense of the timing. And as times grow nearer to a major turn, Michael has certain tools that seem to give him an edge in predicting that event. So it's very valuable, obviously, to have that ability to do that, and that's why we're very pleased to have Michael with us again. Thanks for joining me, Michael.
Good to be here, Jay.
Really always good to talk to you, and I'm glad you're with me frequently on this show. Now, I might just tell my listeners that they should go to olivermsa.com. That's Oliver, M as in Mary, S as in Sam, A as in Albert, olivermsa.com to learn more about Michael's work and his service. Michael, you put out a missive this morning updating your subscribers to a few core markets, including a couple of the major U.S. equity markets, the German and U.S. government debt instruments, for example, gold and oil. And you indicated that you are more focused on the short term now than you have been in the past, perhaps. Why are you so focused on the short term for some of these key markets right now?
Well, as far as I'm concerned, the MSA methodology argues that equity markets have had a major momentum breakage. Now, that quite often momentum will turn before price shows any evidence of a turn. And I'm talking about long-term timescales of annual momentum and so forth. And that occurred in January. And they're trying to shake it off with this rally, which is not untypical. For example, in 2000, there was a major momentum breakage in January of 2000, followed by a rally into March. That was a meaningless rally, but it was nevertheless an attempt by the market to short-term escape from the edge. It ultimately did not escape. Once the big scale of momentum breaks trend and shifts in a new direction, it's nothing's inevitable, but it's a very strong pull. So I'm pretty convinced we're topping. That's step one. I think the next signal one looks for is more precise as opposed to the big breakage. You're looking for the more pinpoint turns. I suspect that this weekly rally that we've been in now for some weeks is about over. It may last into the first week of March. It might. I'm not confident one way or the other on that, but I'm pretty confident that it won't last months. We're talking days here into the first week of March. What I'm looking at are numbers below both the S&P and the NASDAQ 100, which, of course, is in a leadership role here, that if you slip back down just marginally this week or next, especially next week, the numbers get very tight, I see enough weekly momentum breakage to indicate we're turning down. But there's a simpler approach now, and I normally don't rely on price, because price is often deceptive, because everybody can see it. And something everybody can see and use is, it's used, okay?
Yeah.
But in this case, I think you can trust price. In the case of the S&P, if you'll get a price chart on your screen or wherever you have one, and take a look at what happened this year, not last. Last year we were up at 2093 at a high. But we dropped down into January, and we had three rallies that each peaked just above 2060. In fact, 2062 to 2063 were the closing peaks of three separate rallies. We finally burst through that and have run up now to 2115. If you close a day out back below that cluster of closes, I'm of the opinion that is an abort signal, meaning we're on our way down. We're breaking back through the ceiling. The breakout is being aborted. NASDAQ has a similar, NASDAQ 100 I'm speaking of, has a similar structure on its weeklies around 4,300. It's now in the mid-4,400s. So the percent distance from where the markets are now in these price chart levels is not all that great. It's not that wide. So the margin of safety for the bulls right now is fairly slim. So they need to watch their P's and Q's here. And I think if price breaks down through those levels, you can take it at face value. That's an abort. Market is failing.
In lay terms, in my mind, I'm thinking as I'm listening to you talk about riding a what do you call it? What are those things you go up and down the roller coaster?
Roller coaster, yeah.
And as you're approaching, you're going up and up and up, but slowing down. You're still rising, and then you reach an inflection point, right? And then it's down the other direction. Is that kind of what you're measuring?
My visualization of an abort is the old films in the late 50s and early 60s down at Cape Canaveral, when they'd shoot a rocket up, unmanned at the time, and you'd see it go up about 2 or 3 stories in the air, falter, and then fall back to the ground. That's my concept of an abort. It's a launch that fails. And the breakout on the S&P above that 2060s and NASDAQ above 4,300 has gone a certain distance, but it won't be much to abort back below there. And if it does, I think it's a failure, much like the visualization I just gave you.
Your tools are allowing you to see, with rising probability, a peak or a valley, I guess. And
correct.
While the prices are still rising, your intelligence is letting you know, your tools are letting you know that is coming to an end. And yeah, I mean, it's you obviously put out and talk constantly about these major markets to your subscribers, and I'm finding them very, very helpful, Michael. I want to thank you for your fine work, and again, encourage people to go to olivermsa.com. You also talked, of course, our favorite market here on this show is gold. What are you seeing in the gold markets these days? I mean, we're looking at about $1,200 today as we're talking, I think.
Yeah. There's a zone of support that I defined in a report like a week or two ago between the high 1190s and 1203. And we actually traded as low as 1190 today on the active contract. The April close, I think, is around 1197 on the spot month today. We're grinding in this zone of what I think is support. It's not evident on a price chart, but on certain momentum charts, it's pretty clear as a possible floor. So far, it's behaving. It has yet to come up out of this hole, and I need to see that evidence. Evidence that we're turning back up would be something like close out this week around 12:15 would be ample evidence. That doesn't ask a lot. If you saw that, I think that the sell-off is over. But the big numbers that I really need to see to be able to, with full confidence, think the long-term trend is fully changed, back to upside, was for this quarter to post a weekly close credibly above 1,300. Now, I've done my calculations for the second quarter because a lot of numbers change. And all I need in the second quarter, which is 5 weeks away, is a 1285 weekly close. So what we have to do if you're a gold bull is it needs to be supported around the current levels. Need to see a minor upturn. 1215 should do it on a weekly close. And then we move back up toward those numbers I just specified. If you can clear those numbers, I think it's green lights across the board. I think a major trend change, the bottom is completed. We're going up. And I think that probably will be similar or an inverse to some other markets that will be doing the opposite.
Well, we know gold is negatively correlated over long periods of time, at least against equities and some other markets. What would cause you to think that it's not going to hold? What key numbers would you be looking for? I guess
I'm a little foggy on that, I will admit, but getting below the support credibly on a weekly close, like closing in the 1180s, would bother me.
Sure.
It would put me more of a, instead of, I've got a moderately bullish stance, I'd call myself a 60-70% bull. But getting back into that zone fogs up the situation a bit. So I'd have to watch for that. I don't particularly want to see a weekly close much under the 1190.
Yeah. Okay. Good enough.
Okay.
Well, yeah. I mean, we're hoping most of us are on the long side of the gold market in one way or another, either in the bullion or in the shares. So I know that recently you sort of opined that you thought maybe the shares might lead the bullion up this time. I
still think that if the answer to the gold question is upside, that the better places to be over the next years is going to be miners. Gold miners, and I mean, you can pick and choose among the various if you're expert at that fundamental of each company and so forth, but I just look at some of the ETFs like GDX or the Junior Gold ETF. I think they will vastly outperform bullion, and that's a spread assessment that I concluded some months ago, that the next bull trend, the miners will beat the bullion. Also, I think silver is likely to beat gold on upside. But again, I use gold as my benchmark. It's the papa, and as it goes, these others will follow. But I don't think they'll follow. I think they'll actually lead if it turns up conclusively.
Well, that's consistent with the thoughts of several other people that I talked to as well. I guess with the minute left here, Michael, on the risk on risk off trade, TLT to the junk bonds or junk, let's say high yield bonds. How is that looking yet? That's a trade I put on.
It had a very sharp break recently in that spread. It was a big break, but it actually did not break anything of significance in my work. It was just a sharp drop within the uptrend. It's rebounded sharply in the last several days, by the way. I tend to think that the debt markets, let's call it just TLT, net direction of TLT, which is the 20-year government U.S. debt maturities onward. So it's in between the 10-year and the 30. I think its uptrend is safe. I'm not sure how dynamic it'll be. I suspect if you do get an equity downside, you will get a flight to safety into that some more that'll help that trend age another quarter or so, the uptrend that is in the TLT, the drop in yields. But in the latter half of this year, I'm looking for a top in the bond market and the T-note market, and for an inflection point where rates rise. I'm talking long rates. But for now, I don't see that. I think that risk is not imminent. I think it's something that's probably a Q3 event or later.
One more thing real quickly, if I might, and this is partly because my next guest is Chen Lin, who is quite invested and has been in various oil markets, especially some key stocks that he really has taken an interest in that have performed very well. Just quickly, you still think that we haven't seen the lows in oil yet?
I suspect it's better odds that you're going to see a new low. Now, the only question is whether you're going to see a $20 low or something like that a lot of Johnny-come-lately brokerage firms have come out and called for $20 oil. Of course, they were nowhere to be seen when it was coming down through 100 and it was breaking things. But now they're suddenly bearish, and I don't pay attention to them. I do think a new low is likely. The question is how deep. I have to assess the low when it occurs. It's not highly likely. It's virtually impossible for my momentum work to confirm a new low, meaning when you do make a new price low, whatever that low is, momentum is not going to be making a new low, in which case that is probably the final low for the oil sell-off, which is a precursor to an upturn. But so a new low is actually a bullish thing from my perspective. And I suspect in the next few months we're going to see a new low in oil, if not sooner.
All right. Well, thank you very much, Michael, for being with us again, sharing your insights with our listeners.